Today, we're going to talk about adding a little bit of safety to our portfolios. What you can see here is the Consumer Confidence Index. And from about mid 2021 until present, we see a very slow and steady decline. And from 2021 until present, we can see that decline is across all generations. Probably the least steep in the decline of consumer confidence is the silent generation. And we see that there is a gap between present situation and expectations within consumer confidence. And we can see that both of those measures are also on their way down. And we see some weakening in the job market. US payrolls rose 50,000 in December, which was less than expected. However, unemployment did fall to 4.4%. Monthly job creation was negative in both September and October of last year. And we see that there is a revision in October, revised down again to 173,000. We do see it positive in the past couple of months, but we see this overall trend since 2022 on the downward slope. And we do see that although unemployment did come down in December, the overall trend since 2023 is on its way up. So that brings us to this article by the Motley Fool. So the best stocks to buy with $1,000 right now, according to Reuben Greg Brewer, are three companies. We have Conagra, we have Coca-Cola, and we have Procter & Gamble. The key points of this article is that consumer staples have only gained 1.5% the past year compared to 17% for the overall S&P 500. Now, we're not expecting that consumer staples is going to ever come near the 10% average of the S&P 500, but if you are a contrarian investor, now is the time to look at consumer staples. So what is a contrarian investor? It's somebody that looks for beaten down stocks, beaten down sectors where we suspect that there might be a recovery in the short to near term. And we want to invest in those companies now while the prices are low to try to capitalize on the gains that they're going to hopefully someday see. Now, if we look over the past month, we see that XLP, which is the Spider Select ETF for consumer staples, is up 2.67% compared to VU, which is the S&P 500, 1.83%. However, in the past 3 months, we see that VU is up 3.45% compared to consumer staples 2.69. And zooming out to a year, we see that massive difference between the S&P and consumer staples, 19% versus just a tick over 5%. And over about 15 years, we see that gap just widening. We see that the S&P 500 is up over 700% versus about 340% for consumer staples. Now, consumer staples do not contain the big tech companies, the fast growers. They contain slow and steady, typically dividend-paying companies that while you don't see fantastic returns over time, you do see gains in terms of dividends. Total return does take dividends into consideration. So if you had reinvested dividends into XLP, you're only getting about 341% over the past 15 years versus 736% in the S&P 500. However, in the 5-year chart, we do see that perhaps consumer staples have some catching up to do. Since about mid to late 2024, we see that consumer staples have been basically flat. And the S&P 500 has had a fantastic run, mainly driven by the tech companies like Meta, Google, Apple, Microsoft, Tesla, those types of companies that are just huge growers. So the question is, are consumer staples bound to make a rebound? And if so, what specific companies do we like within that sector to put into our portfolios for a little bit of safety if we do see some economic uncertainty and a recession ahead? All that I ask is that you like this video. If you get something out of it, consider subscribing to the channel. I would really appreciate it. We're going to look at two companies from that Motley Fool article. We're going to look at Coca-Cola and Procter & Gamble. We're going to exclude Conagra mainly because they don't report a PE ratio, and so we can't compare that to the other companies that we're going to look at, and we cannot look at a 5-year forward PE. However, what we can do is add more companies to the list that we can analyze in consumer staples. We're going to take a look at those right now. So first on the list is Archer Daniels and Midland. They are a food processing company. We see that they have very low debt to equity at 0.4. They have grown their dividends for 53 consecutive years, meaning that they are not only a dividend aristocrat, they are a dividend king. Current yield at 3.3%, which is about inflation right now. 5-year forward PE at 22. The second company that we're going to take a look at is Church & Dwight. They have a payout ratio of a nice 42.6%. So that means that their 30 years of dividend growth will probably continue into the near to midterm. Current dividend yield of 1.4%. They have grown their dividends about 4%. Current PE 27, 5-year forward PE at a 7.5. We have Hormel, another food processing company, debt to equity at 0.4, dividend yield at a very nice 5.1%. That's one of the highest that we'll see in this video today. However, their payout ratio is 133.6%. So they are dividend kings, growing their dividend for 60 consecutive years. However, that is under threat with a high payout ratio. KDP is Keurig Dr. Pepper, 5-year forward PE, one of the lowest that we'll see today at 11.6, PE ratio at 24, dividend yield about inflation at 3.3. Coca-Cola, we see just based on the number of bold face type that we see in this row here, that Coca-Cola is going to be one of the better companies that we're looking at today. PE ratio at 23.3, return on invested capital of 14.8, return on assets at 10.6, dividend yield just a tick under 3%. They are growing their dividends about 5.2%, and they have grown their dividends for 64 consecutive years, meaning that they are a dividend king. Payout ratio, a little high at 73.2%. We also have Procter & Gamble, which was featured in that Motley Fool article. Also, great numbers across the board. Dividend yield at 3%, dividend growth at 5.5%. They have grown their dividends for 70 consecutive years, and so that makes them very, very firmly a dividend king. Payout ratio, second lowest that we'll see today at a decent 62.2%, so nothing really too concerning there. And finally, we have Tyson Chicken. Dividend yield 3.6%, 5-year forward PE at 12.3, free cash flow yield at 5.8%. If you're new to this channel, what we typically do is we score these companies based on both safety and growth. However, today's focus is mainly on safety. We want to make sure that we have dividend-paying companies, companies that have been around for decades, if not over a century. We want to make sure that they've seen recessions, that they've seen inflation, that they've seen wars, that they've seen every single economic condition under the sun. Those were hopefully going to be more likely to weather those storms and make it out on the other side safely. Okay. So what we do is we score companies between -10 and +10. -10 is the worst company in the world. Don't even look at it. +10 is the best company in the world. 0 is a neutral sentiment, but we typically want to choose companies that have scores of 5 and higher. So going from the bottom up, we see Tyson Chicken coming in at a 0.5. That is slightly positive. That's slightly more than neutral. However, we want to be picky and choosy with our money. We want to choose companies that have scores of 5 and higher. Hormel comes in next at a score of 3. KDP comes in at 3.5. CHD, Church & Dwight, comes in at 5. That's our first company that we see above a level of 5 today. So that would be something that we would want to maybe take a deeper, closer look into. ADM, Archer Daniels and Midland also coming in at a 5. Coca-Cola coming in at a 6. And finally, the top of the leaderboard is Procter & Gamble coming in at an 8. So yes, we want companies with high scores, but we also want companies where we make sure we're getting a good deal, a bargain at their current stock price. And so that's where intrinsic value comes in. We want to make sure that we are buying companies cheap. And so what we're going to do is we're going to run 4 different intrinsic value calculations. We're going to do a PE ratios model. We're going to do a dividend discount model. We're going to do a discount cash flow model and the Peter Lynch valuation model, which is a variation on Peter Lynch's PEGI model. If you want to see what those mean, what they compute, and how to make these spreadsheets yourselves, I'll link some videos in the description of this video so you can build these out yourselves and you can run your own valuation models for not just the companies that we're talking about, but for any company that you want. And so what we typically do is we do all 4 of them, including the dividend discount in this video, because all these companies pay a dividend, and we're going to average those 4 intrinsic values together, and we're going to get the main intrinsic value, compare that to its stock price, and see what margin of safety we're going to get. So let's see where these companies stand. The first is Tyson Chicken. Intrinsically, $68 per share based on our calculations. They are currently trading for $58 per share, meaning that they have a 14.7% margin of safety. Now, their score was only a 0.5, and so this is the weakest of the 7 companies that we're looking at, but they do have a margin of safety. Remember, on this channel, we typically want margins of safety 20% or higher. And so Tyson Chicken may not fit that bill for our purposes on Interflame Finance. Next company up is Hormel. We'd be paying a 10% premium for this company. They came in with a score of 3, intrinsically worth $21 per share. However, their current price is $23 per share. Keurig Dr. Pepper, margin of safety, 22.8%. However, their average score wasn't the highest because their safety score wasn't the highest at 3.5%. So maybe this is something that you would want to consider. Maybe you want to see stronger numbers in their bottom or top lines, in their conference calls, whatever. But we do see a 22.8% margin of safety. Next up is Archer Daniels Midland. They have a very healthy margin of safety of 32%. Their current stock price is $62 per share. Intrinsically, we think they are $91 per share. That gives us an average score of 5 for that company. CHD, that's Church & Dwight. Margin of safety, negative 48%. So we'd be paying quite the premium if we were to buy that today. Current stock price is $86 per share, intrinsically $58 per share. Coca-Cola, also paying a premium for that today. We feel that intrinsically it's $51 per share. They are currently trading for $71 per share. And then finally, the highest score came in with Procter & Gamble at 8. However, we would be paying roughly a 12% premium for Procter & Gamble today. Intrinsically, they are $127. Their current stock price is $142. So these buy heavy and buy columns, what they represent are when you would buy these companies based on 35% margins of safety or 15% discounts in those stock prices. So for example, if you absolutely wanted to buy Church & Dwight, okay, its current stock price is $86 per share. We feel that they are intrinsically $58 per share. If you wanted to buy with some cushion, with some safety, you would buy Church & Dwight at about $49 per share. So we want that stock price to fall from 86 down to 49. And we would certainly buy heavy if that price fell all the way down to $38 per share. And so if you want to pause the video here and check out these prices, again, this is not financial advice. We're not telling you to buy, hold, or sell anything in your portfolios. But what we do on the Interflame Finance portfolios is we want to make sure that we buy quality companies, but we want to get them at bargain prices. And so really the only company that fits the bill today for the Interflame Finance methodology is Archer Daniels Midland. Okay. They have a score of 5, which is the absolute lowest that we would probably consider in most cases. And they have a pretty healthy margin of safety of 32%. Now they're currently trading for $62 per share. So we would buy very, very heavy if they drop down to about the $59 mark, but we would consider buying Archer Daniels Midland until $77 per share. They're intrinsically $91 per share. Now, one final note before we let you go, we do notice that the Peter Lynch valuation model does skew toward the lower end of the intrinsic values. And so we ran these numbers again without any Peter Lynch intrinsic value calculations. And so I'll just pull this down and let you check these values out. We do see that it lifts the margin of safety for all these companies because it does lift the intrinsic value for all these companies. Some are still negative, some are just barely positive, but we do see that Procter & Gamble does turn slightly positive at 6%. They are scoring very solid 8, and so that might be something to consider, even though they don't have a fantastic margin of safety, 20% or higher. Before buying or selling any stock, always do your own research and due diligence. Nothing on this video is financial advice or any sort of stock recommendation at all. Investing always involves risk, and past performance does not necessarily guarantee future results. Thank you for watching. I appreciate you being here, and we'll see you in the next video.